Good morning, everyone. Thank you so much for watching my YouTube channel. Today, guys, SSV 500 is negative 1.8, Nasdaq is negative 2, Bitcoin negative is flat, guys. So it's almost less than 29,000. And guys, you saw Alibaba news came today that Alibaba guys launch open source on AI model in challenge to Meta. So this Alibaba guys is want to challenge Facebook. And remember guys, people calling Alibaba will be Amazon for China. Okay, when you go on market also you see Apple earnings. What will you expect? Remember today guys, Apple earning will be released today, and we know guys, I think Apple will be moving upward today. We saw big tech earnings were moving upward, so I think and let's hear this news about dollar, and I will start to other things.
Let me kick it off with this chart, which, in another way shows the strength that we've seen, the rebound, if you will, in the greenback. We've seen the DMA, the 50 DMA for the first time since July slump, and the dollar sitting above that now. So, how difficult does it make it for some of these trading pairs? I know you necessarily probably don't focus on emerging markets, but certainly in a lot of ways that divergence and the gap is growing.
Yeah, and I think a lot of it comes back to the resilience of the US economy. So about a week ago, we had the GDP for the second quarter, which was stronger than expected. The recession talk is really fading in the US, and while they've clearly signalled that they're probably not going to go in September, they're keeping an open mind. The markets think they probably won't. The risk is still there that the economy ends up being more resilient, and that lends support to yields, and that does put pressure on emerging markets and other currencies where, say, the Aussie dollar, where rates appear to be on hold for a while. So it's a second win for the US dollar. We don't see it going back to where it was last year, but it's definitely actually on pretty good footing right now.
Yeah, our previous guest calls it the sort of nirvana trade, like the assumption that you get sustained disinflation without the labour market taking a knock. Is it kind of really tantamount on that being able to materialise in the longer term?
That would be very helpful. Yeah, I mean, that would essentially, if you're betting against the US dollar, as a lot of us have been for the past 6-12 months, you're counting on the Fed starting to ease, and once it does, that the US dollar loses a lot of support and people look for where the better growth stories are. But if growth is resilient, inflation comes down without really crunching the US economy, then that is a pretty good situation. You may still look for other currencies to diversify, but it's hard to be super bearish the US dollar if that is that sort of Goldilocks outcome.
What's driving the Japanese yen right now, especially when you have the 10-year yield continuing to really be pushed higher? Are you expecting the BOJ to step in again?
Yeah, look, that is a very good question. So we did think that what the BOJ delivered last Friday was yen supportive. It was very messy trading on the day, though, and obviously we had bouts of yen weakness. There must have been some hedge funds, I would say, who were betting on a very major change. But to us, it is very significant to raise to 1% on the top side for the 10-year. They'll remain in the market, keep the market honest. But the fact is they've set themselves that it's the 1.0 level that is the key to them now there, and that is a notable change, particularly if they keep underestimating the strength of CPI. So it is a sort of multi-week, month story perhaps for the yen to make a recovery, but for the most part we did see about 24 hours ago a little bit of support for the yen against the US dollar on the ratings downgrade, but while treasury yields are trending back upwards again, that does suggest yen weakness.
You also say in your notes that you're short euro yen, short pound yen. This, of course, as we are headed towards a BOE rate decision as well. Give us a little bit of the background for your rationale here.
Yeah, we think that obviously the market's very divided on the pound near term. It's had a pretty good year overall. We do think it's getting pretty stretched on some of those crosses, whether it's sterling yen or sterling CAD. If we do get the 25 delivered, then obviously that would be a hit to sterling. We are seeing signs of inflation easing. Obviously, the UK has had a horrible inflation run for the past couple of years, worse than pretty much any major economy. So you do want to see that improvement, but yeah, in terms of the shop prices and so on, there are signs that the price pressures are easing, and that will take a bit of pressure out of sterling. And the economy is it's avoided recession, but it's still not tracking that well. So it just looks stretched to us.
Let's start off, Mike, of course, with that announcement at the Kansas City Fed. An announcement, of course, that we knew was a long time in the making. We just finally learned who it's going to be. We did. Jeffrey Schmidt is like his two predecessors at the Kansas City Fed, a former bank examiner. He started there in 1981 at the FDIC, actually, in Kansas City, but worked his way up through the banking business to the point where he was running Mutual of Omaha and American National Bank in Omaha, and then a family-owned bank down in Dallas before he ended up at SMU. He will take office, as Katie mentioned, on the 21st of August, which is 3 days before the Kansas City Fed's Economic Symposium in Jackson Hole starts. So it's going to be interesting to hear from him when he gets there about what he thinks of economic policy, since he's not an economist. He's a banker.
And of course, he will be a voting member in 2025.
How did you respond to that yesterday?
I think, like everyone else, I scratched my head a bit and said, really now? And oh, by the way, we've got 150 companies in the S&P.
We are getting some data from the Treasury Department as they announce what they plan to do with their financing for this quarter. The expectation is that they're going to borrow quite a bit more than they previously expected, which did lead to a sell-off in the 30-year yesterday afternoon. Right now, in the 30-year Treasury, you can see it going up 4.1%. That is the highest level going back to November. Joining us now with the latest numbers from the Treasury Department is Michael McKee. Mike.
Well, Lisa, the Treasury said they were going to borrow over $1 trillion in this quarter, and the question is, how are they going to pay for it? Well, pretty much as the market expected, by raising auction sizes. Not so much in August, but they're going to raise throughout the quarter. Here's the first refunding numbers that come out for this month. These will be auctions held next week. $103 billion total, refunding $84 billion in maturing securities and raising $19 billion in new cash. And as you can see, 3-year note at $42 billion, 10-year at $38, and the 30-year bond comes in at $23 billion for next week. Now, the increases I talked about are going to be relatively substantial, but again, not unexpected. They're raising the 2-year by $9 billion, the 3 by 6, and the 5 by 9, and then 7, 10, and 30s, as well as they go through the quarter. They will parcel this out month by month, but it will end up with a much higher auction schedule. And they say going forward, it'll depend on the performance of the economy and, of course, what tax receipts come in. One other note of interest in this release is that the Treasury says it has made significant progress on its plans to implement a regular buyback program in 2024. They don't have that program in place yet, but it does seem to be moving forward, so that is something to look forward to perhaps at the next refunding. We'll see you in November for that.
And just real quick here, it also says the Treasury does expect auction sizes to be boosted going forward. So how much is this a sign? This is just a signal of what's to come.
It's a signal of what's to come, but again, the mixture is what matters to the market. They do say they're going to raise Treasury bill issuance some, because they're still trying to rebuild the Treasury general account and get to $600 billion by the end of September.
How does that dovetail then, Nathan, into this idea of some spike in unemployment?
Okay, thank you so much, guys. I will go to do more technicals about the dollar and stocks. We know, guys, dollar right now is bullish, and I will go to show you the technicals on next video. And let me put this city sheet, especially recession city sheet. So let's hear.
Employment and this sort of hard landing type of narrative that has been all but taken off the table.
Right. So on the one hand, we've had the labor hoarding, in my view, in the manufacturing sector. Maybe some of that's starting to give. But I think that we need to see some easing in services spending, a rise in the overall savings rate. I think we will see that, but it's more likely to be an early 2024 story. And there's more uncertainty around it. I mean, many of our competitors are shifting their macro calls away from recession in early 2024 to soft landing. You know, based on history and the tightness of the labor market and some of the imbalances in the economy, we're not there. We still think that there will be a recession next year, but boy, this is a very, very finely balanced call between soft landing and recession.
Where have you got rate cuts?
We've got them in Q2.
So there we go.
So
we're arguing over 6 months here?
Broadly, I'd say broadly speaking. Now, where it gets a little trickier is if we're wrong and there isn't a recession and we're looking at a soft landing. I think a feature of a soft landing scenario that is not getting enough attention is it means that rates are going to be higher for longer. That recession is going to open the door, if and when it occurs, to more aggressive Fed rate cuts. If we don't get it, it's going to be a gradual glide down in the Fed funds rate in coming years.
When you say that rate cuts are going to happen, does that happen well before inflation rates are south of 3%?
I think that in engaging inflation, it's really important to be looking at those monthly prints and thinking about them. And I think that it will happen in our forecast kind of in the second part of a 2-quarter recession. And by that point, the Fed will be fairly confident that inflation is moving down sustainably into the 2.5% range.
Would the downgrades off the back of it matter? Would they have consequences? Elsewhere, have we got downgrades because of those reasons elsewhere?
I don't think so, and we go back to what did Fitch do, and you have to go back to May when they put it on watch. That was a pretty clear signal that in no reasonable period of time would the U.S. be able to get its fiscal deficits, debt to GDP, or how the governance process works into line with what are the 9 other remaining AAA rated sovereigns. And if you go through them one by one and look at debt to GDP, the U.S. is headed to 120%. The median of the other 9 AAA rated Fitch sovereigns is 39%. You look at fiscal deficits, the U.S. is going to run -6 to -7%. 0 is the median of the other 9 AAA sovereigns. So you're miles away. I won't touch governance. I think I heard what Anne-Marie said.
I think that's been dealt with already this morning, Bob.
Yeah, do you know what? We have a lot of clients who love the U.S. markets, love U.S. assets because of the rule of law and the governance. They like the transparency. They like to see the battles on the floor.
Well, this is the most important, least important data of the month, and it comes in 324,000, which is a lot bigger than the 190,000 that had been anticipated. However, the previous month, 497, we'll have to see if that's revised, was much higher than the government reported on Friday. Right now, it looks like the big change in goods producing comes in natural resources and mining, as manufacturing lost 36,000 jobs, ADP says. They said they had lost a lot of jobs last month, and that hadn't happened. Service providers add 303,000, and of those, 201,000 are in that leisure and hospitality group that we like so much. 237,000 jobs in small establishments, 138,000 medium, and large establishments, large businesses lost 67,000 jobs, they say. And finally, we get the pay change numbers from ADP. Job stayers saw their pay increase by 6.2%. Job changers saw theirs increase by 10.2%, and those numbers are down from previous months. month, so that does look like perhaps some good news for the Fed. They do pay attention to some of that. And you know what's really interesting is the Fed gets these ADP raw data, and they have their own model that they make out of it, and it doesn't seem to match up with what we get. But at this point, ADP suggesting a stronger than expected July payrolls number coming Friday.
Thank you so much, guys, and have a nice day.
Of course, are reacting.